Consolidation of financial statements. So today's topic is this, which is covered under IFRS 10. Now, what does this basically deal with? The main concept of this IFRS is revolving around one word, which is called power. So there is power equation between two different entities, and that is where this consolidation standard comes in. So what is this power? Let us understand quickly. Now, firstly, when does this IFRS 10 come into play? So let us look at the applicability. When is it applicable? It is applicable only in one scenario. That is, there has to be a parent and subsidiary relationship between two entities. So one entity should be the parent company or the holding company. Another company should be a subsidiary company. When such a relationship is there, only then this IFRS 10 on consolidation comes into picture. Otherwise, IFRS 10 is not required. Let us assume there's a company, standalone company. It neither has a holding company or a parent company, nor has a subsidiary company. We don't have to look at IFRS 10 at all. Now the question is, who is this parent and subsidiary, or what is this relationship like? Now, this is where the equation of power comes. So when we say parent and subsidiary, parent has control over the subsidiary. Now the question is, what do you mean by control? Now control can be divided into two types. One type of control is called substantive control, and another type of control is known as a protective control. Let us first understand what is protective control. Now I'll give you two examples of protective control. For example, you want to open up a McDonald's store. You can open, by the way, McDonald's is a franchisee, right? If you want to open a McDonald's store, all you have to do is approach McDonald's company, correct? Tell them that at a particular place you want to open up a McD store. You have to pay some amount. Once you pay some amount, they will let you operate McD. Right now, I think McDonald's franchise goes into crores, okay? It's close to 5 crores, I guess, roughly something like that. Lump sum, you have to pay that much to the McDonald's company, and you can put up your McDonald's store. But imagine this. If you once open up a McD store, what do you sell? You obviously have to sell burgers and french fries and coke and ice cream. Whatever you sell should be according to the menu given by the McDonald's company. You cannot say that I have paid you 5 crores, I am a franchisee, so inside a McDonald's now I'll sell you masala vada and pav bhaji. No. Why? Because McDonald's controls you. What kind of control is it? This is a protective control, meaning to protect the McDonald's brand image. They are controlling you by telling you that we have given you the franchisee. That doesn't mean you will start selling biryanis and you will start selling chapatis inside a McDonald's, correct? Upma you are selling. No, not possible. We are controlling. This kind of control is called a protective control. I'll give you another example of protective control. Normally in Companies Act we see that major decisions, when they are being taken, at least 75% or 3/4 majority of shareholders should be saying a yes. Okay. Now let us assume some person has 15% shares. Now obviously someone who has just 15% shares by himself cannot go and pass a special resolution which is 3/4 majority, because they need 75% votes, correct? Now assume that already 65% people have said yes. Okay, already 65% people have said a yes and all others have said a no. Now this 15% people have become the deciding vote, meaning already 65 is a yes. If these 15% people say a yes, it becomes 65 plus 15, 80, which is more than 75. So special resolution will get passed. If this 15% people say a no, then yes votes will only be 65%, because all others have said a no. The special resolution will fail. Now imagine, what if this 15% shares are held by a single person? It could be a real person like an individual, or it could be, think about a company, artificial person holding that 15%. Now suddenly, even though it is just 15%, they became the biggest decision maker suddenly, right? Because 65% are shares held by someone else. They said a yes, everyone else is saying no. you alone having 15% votes, if you say a yes, it's going to be a special resolution and a yes. If you say no, it's a no. This also is an example of protective interest. So first thing we need to understand is protective control does not establish parent and subsidiary relationship. So if there is protective control equation between two entities, those will never be called a parent and subsidiary, and hence IFRS 10 is not applicable for them. Simple logic. Then what kind of control is it? Substantive control is what gets IFRS 10 into picture. Clear? So protective controls ruled out. Now if we can establish that two entities are sharing a substantive control among themselves, yes, then they are called a parent and subsidiary. Now there is a relationship. That is when IFRS 10 comes in. Now what is this parent and subsidiary relationship? What do you mean by substantive control to establish that? Now I'll give you a few examples of substantive controls, just like I have given examples for protective controls. One example could be one company, let's say company P. P means parent, S means subsidiary. Company P has control over company S in the terms of how company S should be doing its activities. So activities of company S are controlled by company P. This kind of control can be qualified as substantive control. Another example could be, I'll tell you multiple ways this kind of power can be exercised. Majority shareholding, which means more than 50%. If P company has shares in S company, automatically now there is substantive control. Similarly, no, we do not have more than 50% shares, but we have more than 50% voting rights. P Limited has in S Limited. Again, you can control them. This is again an example of a substantive control. Similarly, there could be another kind of substantive control, like I neither have voting rights more than 50% nor have shareholding more than 50%, but I have the control over the composition of the board of directors, which means who can become or cannot become a director in S Limited, P Limited decides. Correct? So in a way you have got control over the composition of the board of directors in the other company. So again we have established some form of a substantive control. Another example could be, to become a director in S Limited, you have to be an employee in P Limited. Only employees of P Limited can become directors in S Limited. So in a way, you have again substantive control, because your employees sit there. Being your employees, they will run that company the way you want them to, because you give them salaries. Again, substantive control has been established. Another example could be operating dependency. In the sense, S Limited is totally dependent on P Limited for business. Okay, S Limited cannot even function if P Limited does not allow it to function. So there's operating dependency. This also establishes substantive control. And also it could be P Limited has the rights to appoint key managerial personnel of S Limited. In the sense, who should be their production manager, who should be their marketing director, who should be S Limited's HR director. All the key people are being appointed by P Limited. So key managerial personnel are getting appointed by P Limited on S Limited's roles. Again, this shows substantive control. So now are you clear? Control is of two types: substantive controls and protective controls. Protective controls out of IFRS 10, because we cannot establish power. Correct? Power comes to the parent over the subsidiary when you can establish a substantive control. Now you are clear with all the examples of substantive control. Now the next question that comes is power the only equation? No, there is another equation. This equation is called exposure or rights to variable returns, meaning the equation between P company and S company is in such a way that because of what happens in S company, P company's incomes or remunerations or returns change. That is called variable returns. So we have some equation between the two companies that the parent company's incomes are dependent upon the subsidiary company's returns. Correct? and they are varying, variable returns, and parent company is exposed to such variable returns. This is another way of establishing again substantive control. Again, also another thing could be understand this. So in a way, S company does not have its own individuality. S company is more acting like an agent of P company. So there's a principal and agent agency relationship has come. So again, this shows that there is substantive control. Getting the logic? So these are all the ways in which we can establish substantive control. Now, once we have established substantive control, now IFRS 10 kicks in. We have to use consolidation. Simple. What do you mean by consolidation? Because you have so much control over the other company. So the other company's profits, losses, assets, liabilities, cash flows, all of them are your profits, your assets, your liabilities, your incomes, and your cash flows also. So when P company makes its balance sheet, S company makes a separate balance sheet, but P company has to make a separate set called consolidated accounts, where it will merge both P and S limited's balance sheets and profit and loss accounts into one consolidated statement. Because that company belongs to you, you have substantive control over that company. This is the main concept of IFRS 10, that is consolidating parent company and the subsidiary company's books together into one set of books. So parent company will have its separate set of books also, subsidiary company will have its separate set of books also. Together they will have a consolidated set, and the duty to make that consolidated set of financial statements is lying on the parent company, not the subsidiary company, because it is the controlling company. Now there are certain exceptions. Exceptions meaning, are there any companies, even though they have a holding and subsidiary relationship, even though there is substantive control and all that, still they need not consolidate? Yes, there are certain exceptions. Now let us look at the exceptions. First exception is, the shares of neither the parent company nor the subsidiary company are being traded on a stock exchange. They are not being publicly traded. So it's okay, you don't have to follow IFRS 10 even though you both share some substantive control equation. Now the second one is, both the holding and subsidiary company are not in the process of listing the shares also on stock exchange. So if you are not in the process of listing also, you don't have to, which means even if you have just started the process of listing the shares, you are liable to report under IFRS 10. If you are not even in the process, forget it. Third case, third exception who need not follow, investment companies. Investment companies means, what is the investment company? Investment company's whole purpose is to invest, correct? The whole purpose is to invest in other companies, correct? That is what is an investment company, is it not? So when we are looking at an investment companies invest in so many other companies' shares, correct? By virtue of that, what if they have invested more than 50% share in some other company? They become the holding company, correct? And the other company in which they have invested that money becomes a subsidiary company. So automatically there's a controlling interest, but still it is its business. Investment companies' business itself is to invest in other companies. So you can't ask them to now consolidate their financial statements into investment companies' financial statements. Think about a bank like State Bank of India or an ICICI bank. These people would have given loans to so many companies, right? And so many of those companies may not have repaid. And the terms and conditions could have been in such a way that if you do not repay, SBI or ICICI, these kind of banks may become the dominant shareholders in that company by virtue of non-repayment of a loan. So by default, they became their holding. Like that, so many companies may be there in which a bank or an investment company may be holding shares. So it is impossible to consolidate all those companies' accounts into SBI's or ICICI's books, right? So that's why investment companies are exempted. Another exemption, the last exemption is called, suppose A is holding B and B is holding C, correct? Now A is a holding company of B and B is a holding company of C. Automatically A becomes the holding company of C. Now suppose A, being the ultimate holding company, right, is consolidating C's books into A's books. Now B need not, Correct, na? Similarly, if B is consolidating C's books into B's books, A need not. So either the ultimate holding company is consolidating or the intermediate holding company is consolidating, that's enough. So if B can consolidate C into it, A only has to consolidate B, it need not worry about C. Correct? Similarly, if A is directly consolidating C into its books, B need not worry about consolidating C. Got the logic? So ultimate holding company or an intermediate holding company, when it is ready to consolidate as per IFRS 10, other companies can now relax. They need not follow this accounting standard. So these are certain exceptions of when, even though there is a substantive in control, parent and subsidiary relationship exists also, still you need not follow IFRS 10. Now we have discussed these exceptions. Now let us go further. Okay sir, now that we know in which scenarios we have to apply this standard, chalo, let us start applying. So how to apply this standard? To apply this standard, first you have to take care of a few things. Now what are these things which you have to take care of? Now we have already discussed about control. We need to also understand this control has to be active control. It cannot be a passive interest. Passive interest means, yeah, I like that if that company grows, I like it. Of course, there is some income that comes if that company grows. This is called a passive interest. Passive interest is not substantive control. That has to be clear. Now, another thing, once we start implementing IFRS 10, few things have to be clear. One is the parent company and the subsidiary company's financial years should be the same. Correct? Only then consolidation is possible. The duration of the financial year also should be same, and the reporting date, that is, let's say 31st March, both parent and subsidiary company should be closing their books on 31st March only. Correct, na? Only then the consolidation is possible. The same accounting period and the same reporting date. So that is one prerequisite for consolidation. Clear? Now also another prerequisite for consolidation is that if you are consolidating because you are a parent company, means you may be holding more than 50%. Let us say you are holding 60% shares in a company, because you have majority more than 50%, you became holding, they became subsidiary, which means someone else is holding 40% also, right? Someone else is also holding 40%, which means when we are consolidating, we cannot consolidate full 100% of that company, because we own only 60% of that company. We will consolidate 60% of that company. Then what happens to that 40%? It is not my headache, right? Someone else is holding that 40%, but still the prerequisite of IFRS 10 is fine. You consolidate 60%, but the 40% which does not belong to you belongs to some minority shareholder, right? Because you are the majority shareholder. So if you have controlling interest, they have non-controlling interest. Please disclose who has that non-controlling interest and how much. We want disclosures on those things as well. So in India, we call this minority interest. IFRS calls the same thing as non-controlling interest. It's exactly the same concept. So while you are consolidating your controlling interest, please don't consolidate non-controlling interest, but disclose that minority interest or non-controlling interest also. This is another prerequisite. Now, how exactly do we consolidate? That's pretty easy. You have to combine. What do we combine? Combine the assets of parent company with assets of subsidiary, combine liability with liability, income with income, expense with expense, and cash flows with cash flows. As simple as that. Just add up. Is it only adding? No. There is deletion or elimination also. What do I eliminate? Two things we need to eliminate. One thing is, if holding company has invested money into the subsidiary company, correct? The holding company will be showing it as an asset, and the subsidiary company will be showing it as a capital liability. When you are consolidating, both become one set of books. Asset and liability knock off each other. Correct? So remove the holding between each other. Clear? That is the first thing we need to eliminate. Second thing, intra-group transactions eliminate. Intra-group transactions means in the books of the holding company, subsidiary is coming as a debtor. In that case, in subsidiary's book, the holding will be creditor. But when both become one, debtor and creditor cancel off each other, because you cannot owe yourself money, right? So these intra-group owings, correct, intra-group transactions, these kind of things, please eliminate. So these are two eliminations. Clear? So combine, then you eliminate these, and that's it. We are done with CFS, Consolidated Financial Statements, IFRS 10. is pretty much done. So I hope you got a good idea about it. Let me give you a quick revision. What exactly we have discussed. Number one, when to apply this IFRS? Apply it only when there is a parent subsidiary relationship. When does this relationship exist? It exists only if there is a controlling interest, and we are talking about substantive control, not about protective controls. So once you have substantive control, then yes, please start following IFRS 10. But some people need not follow. Who are these? Investment companies need not follow. If ultimate holding or the intermediate holding company is ready to consolidate, other holding companies can relax, no need to follow. Similarly, if it is not a publicly traded company, no need to follow this IFRS. In the same way, if it is not in the process of listing its shares on stock exchanges, again no need to follow. These are your exceptions. How to actually consolidate is pretty simple. Combine assets, liabilities, income, expenses, cash flows. Eliminate intercompany capital holdings and intra-group liabilities, etc. Other transactions, eliminate. And that's pretty much it. We are ready. Cool. So I hope everyone has a good idea about what is IFRS 10 for consolidation now. So signing off, I am Vijay Krishna Dharani, Chartered Accountant from Cavach Academy. We are Bangalore's best CA coaching institute. We keep making a lot of educational videos like these. So please subscribe to our channel and you'll keep getting more such videos. Thank you. Bye bye.